Told to keep it short, so I already failed with the title. But this isn't actually the title of a research paper. I had to package a few ideas and had to make it sound a bit interesting, so you can tell I would not be a good journalist. But be that as it may. So I thought the best thing to talk about on a rainy Tuesday afternoon is the relationship between earnings and prices. And of course, I'm an accountant, so that makes it particularly interesting. Since I have a lot of liberties in how to present this, I thought I'm going to just write a dialogue. In ancient Greece and Rome, that was typically the way to write an exposition, and the typical people that appear in a dialogue are student and teacher. So that's perfect for Columbia, and you can identify with a student. Okay, so let's sort of think about the relationship between market values and earnings of a company from sort of an abstract theoretical perspective. And just ask a very fundamental question. Again, you're a student, right? You ask your professor, what should the relationship between the two actually be? Why does it make sense to think about these at all? Okay, you pull up the income statement of a company and say, last year they made this and this much money. Why should that be connected to the market value of the company? Well, and your professor, always the academic, will tell you, well, first of all, remember that market value really ought to be the future profits of the company somehow discounted back to today, right? We know that. And then the only thing you need is, well, the earnings that you have today, what shows up on your profit and loss statement, should be connected to your future earnings, and that's going to be your market value, right? So the only idea we really need is that somehow tomorrow tends to look a lot like today. And if you want to be a futurologist and always make good predictions about what the future will be like, the best guess is it's going to be like what it's now. Right? So theoretically, there's our connection. Now, you're Columbia students, you think for yourself, so you say, okay, wait, I can make an inference from this. I know that if the firm has higher earnings today, then if we apply this rationale, it should also have a higher market value, right? Because that means higher earnings tomorrow and therefore higher future profits, and company should be worth more. And your professor gives you a sort of technical response to that because he just remembered something. Okay, so let's look at some data. So we'll just do a very simple plot of earnings per share and of the share price, right? So earnings and prices. And just to avoid any contamination from company-specific effects, we'll do this for a very large sample of companies. So the data I'm going to show you, I based on several decades worth of financial reports for several thousand companies. And each time I said, well, okay, I'm going to take all the instances where I see earnings per share of 2 and calculate the average share price I see for all of these companies. I'm going to do the same thing for earnings of 4 and 3 and 1.2 and 4.37 and so on. And then here's the plot that you get. Right? Okay, so we can see on average, companies that have higher earnings per share also have a higher share price or a higher market value. All right, so you might say, well, that's exactly what I just said, right? Higher earnings per share, higher future profits, higher market value. Nothing wrong with that. Well, it's only half the story. We're missing this half of the graph. And that's sort of the half that people tend to ignore. Because when we think about price-earnings ratios, we want that to be a positive number. We don't really have a good way of making sense with profit that's negative. When we relate that to market value, we don't know how to think about it. Well, it gets worse. We can at least calculate it, and we can plot it. And if you do that, this is what you get. So we know how to interpret graphs, right? We all took the SAT. So what does this mean? If you have earnings per share of about -1, so you're making a small loss this period, your price on average is something like 10. If your loss per share is -4, so you really did badly, your share price is about 15. So your business is losing more money, and therefore I'd be willing to pay more for it. Well, that makes perfect sense, right? So this really doesn't work, right? Our intuition of tomorrow looks like today doesn't work here, because if you have a bigger loss today, you should have a bigger loss tomorrow. And that doesn't really say good things about your firm value. So that doesn't make an awful lot of sense. And this is not an artifact of having big companies over here and small ones over here. This is share price. And I took out the companies that have very small share prices to avoid any contamination. This is extremely robust. And what's worse, what do you think? What proportion of companies shows up over here versus over here? Just give me a percentage. What proportion of companies has a loss in any given period on average? Close. It's actually about a third. It's about a third. So if you grab a random company in a random year, there's about a 1 in 3 chance that the number at the bottom of the P&L is going to have a minus sign in front of it. So this is not something we should neglect. But we do have to do a little more thinking to make sense of this. Okay, so you realize tomorrow looks a lot like today doesn't work. And so your professor says, well, okay, well, that's why. The question you actually want to ask is not what does tomorrow look like, but first, what did yesterday look like? Because what you have on your income statement really is a statement about what happened last period. First and foremost, mechanically, right? Because we're recording what happens over time and then we report at the end. So it's really a statement about the past. Okay, so let's think about a little example here to illustrate what implications that has. So let's think of a company, and the company produces products and it launches a new generation of its product every period. This is typically what companies do. And each product is going to generate some profits. Now, the world is uncertain, so these profits can, over time, wander around. Your costs can go up or down, demand can go up or down, so companies might have profitable products, unprofitable ones, and the ones that are profitable today may no longer be profitable tomorrow, right? Okay, so we're in this world here, and then what are we going to get on the income statement? Well, we're going to get an aggregation of all the current profits of your existing products added together. That shows up on the income statement, that becomes your earnings. What's your firm value? Well, it's simply going to be the expected future profits of all the products that you have added together. Right? So same idea as before. All we've done is we've split the company up into multiple products here. Right? So now we'll think about how the company should manage this portfolio of products that it has. Okay, and so here your professor just shows you this picture and says, think about it. Who is this man? What? Darwin, Charles Darwin. Somebody said it's Santa Claus in the off season, but okay, so Charles Darwin, okay, so what did he bring to us? He was a biologist. Okay, so he brought us evolutionary theory, right? And he said, well, the fittest survive, or as he put it, I created this principle I call natural selection, where sort of every random change that happens in the environment is preserved if it is useful. Right, so what does that tell us about how the company should manage its products and prices and earnings? So you do a bit of thinking and you say, okay, well, I got it, right? So when a product makes losses, then that's a negative variation here, and so the company is going to pull it, right? We're going to discontinue that product. That's a choice that we can make, right? So when to discontinue products that have negative profit. And the professor says, okay, good. You're on the right track, but we have to do a little more careful thinking here. Because once you pull the product, it's not so easy to just bring it back, right? You have an investment that you liquidated, that you can't just reinstate it immediately. So you want to think about how bad do things need to get before we're actually willing to say, all right, enough, we're going to sell this stuff no longer. So let's do a simple example. Suppose you have a product with a profit of -1 right now. And because the world is uncertain, suppose your profit tomorrow is, well, today's profit either +1 or -1 with equal probability. Right? So tomorrow we could have 0 if things go well, or we could go down to -2. Equal chance. Right? And going forward, same pattern. If we go to 0 tomorrow and we wait another day, we're going to go to either 1 or -1. And if it happens to be -2 tomorrow, we're going to go either down to -3 or back up to -1, always with equal probability. Okay? So let's think about this pattern and think about how we want to handle our product portfolio, if that's what it looks like. Just to make things easy, let's assume we can decide to discontinue the product either right now, at the end of tomorrow, or at the end of the day thereafter. And if we don't stop the day thereafter, we're going to continue it forever, just to make things simple and manageable over a lunch seminar, right? In reality, of course, you can continue whenever discontinue whenever you want. And suppose we have a discount rate of 10% just to make everything easy to calculate. All right, we have a decision problem to solve. The best way to do it is to graph it. So we just spell out all the different payoffs we could get. -1 today, well, tomorrow it can be 0, -2. The day thereafter, either 1, -1, or -3. And then if we choose to continue thereafter, what are we going to get? By assumption, we're not going to make any further decisions. So on average, if we have 1 on day 2, we're going to get, on average, 1 forever after, because the probability that it goes up or down is exactly the same. So we're going to get effectively a perpetuity of 1, which at 10% is worth how much? God, math over lunch. Okay, it's 10, right? It's 1 over the discount rate, so get a perpetuity that's worth 10. If we continue when it's making losses, of course, we get a negative perpetuity. What's the optimal decision rule here? Well, obviously, if you can make a profit, you want to continue the product, but if you're looking at losses, you're going to say stop. So the optimal decision rule, if you're on day 2, is, well, we're going to discontinue in these 2 scenarios, right? Makes sense. Roll this back to tomorrow. What are we looking at tomorrow if that's what we're going to do on day 2? Well, tomorrow we could get 1 plus the perpetuity if things go well, and we have a profit of 0 at that point, or minus 1. Well, the average of these 2 is positive. It's plus 5. So if we have a profit of 0 tomorrow, we want to continue. That's worth it. If we're down at minus 2, well, we're looking at losses no matter what happens, so we want to discontinue in that case. So tomorrow, our optimal decision policy would be continue if we're at 0, stop if we're at minus 2. Now, you can see the pattern. We just roll it back to today now. What are we looking at today? Well, we're looking at either minus 2, because after that would be 0, or at 0 plus the expected value of this, if things go well, which is 5 discounted back 1 period, so 4.55, right? And you can see what we're looking at today is actually an average payoff tomorrow that's positive, right? Bigger than 0. So we do want to continue. And in fact, the expected payoff tomorrow, if you do the math, is about 1.28. So we have a product that's making a loss right now. The present value of its expected future profits is actually positive. And not only that, but this is true even though we constructed this by assuming that tomorrow looks a lot like today, right? It was a 50-50 chance each time. We're at minus 1 today. There's a 50-50 chance that we'll go up or down, so the average payoff tomorrow is also minus 1. We still have a positive value in this product here. Now, where does that leave us? Well, so first of all, we learned if you have losses, you want to continue the product. Now, can we just scale that? Is that also true if we start at minus 2? Let's check that first before we overgeneralize here. So let's just quickly draw the tree again. Now, starting at minus 2, populate it again. Everything gets knocked down by 1, and you can tell it doesn't look so good anymore on day 2. So we really want to discontinue no matter what happens here. That means what we're looking at tomorrow is also only bad outcomes. So we want to discontinue no matter what. And that means today we're only looking at bad outcomes. So if we're at minus 2, really our best choice is pull the plug immediately. So conclusion, if you have a moderate level of losses, it's actually a good idea to keep going. As long as there's still some prospect that the product profits will recover, it's okay to keep going. If the losses get too bad, at some point you're going to say, stop, it's enough. We're going to discontinue, right? Well, that's really sort of Darwin's idea of natural selection, right? You're just doing it with products. Companies are strategic, which products they keep, and they keep the surviving ones, the ones that actually have positive profits, or not too bad a loss at least, right? All right, so the professor says, what do we conclude from that? We can have products that have negative net profit, and so they draw down your earnings on the income statement, right? They make your earnings look worse. But as we just calculated, they can still have a positive intrinsic value. We calculated 1.28 is the present value of the future profits from that product. So they're going to increase your market value, right? And so you can have more negative earnings and actually a higher market value. So let's just do a little numerical example here. Suppose we have 3 companies, A, B, and C. They have products of, well, 1 product, 2 product, and 3 products. Each of them has current profit of minus 1. So that means the total earnings that end up on the income statement are, well, minus 1 for company A, because it only has 1 product. Company B has 2 products that each make a loss of minus 1. So they're going to have a total of minus 2 at the bottom of their income statement. And then minus 3 for company C, obviously. What's the market value of these businesses? Well, if you only have 1 product, well, the market value is the value of that product. And 1.28 is what we calculated, right? That came out of our first decision tree. So that's the market value of company A. Companies B and C have more active products. So they are going to have 2 and 3 times as big a market value. So notice the progression here. You got earnings that are going down, down, down. These companies are really doing poorly here, but their market value is going up. Wow. Now, of course, you're smart. You're at Columbia, so you start thinking, you tell your professor, you cheated here, didn't you? Because, you know, this company here, okay, they have earnings of -1. You told us they only have one product. Well, there are many ways to get to earnings of -1, right? For example, well, you could have one product that has a profit of -1, and then two others that have a profit of 0. That would also get you to earnings of -1, but that would add two more products that actually have a higher value. And so that market value would actually be a bigger number than that. So you kind of cheated, right? And so your professor says, well, you know, you do have a point here, but what is going to be true on average is that the company with the earnings of -1 is going to have fewer products than the company that has the earnings of -2 or -3 even. And here's why. Again, let's do a little table with numbers in it. It's easier to see. Let's think about, for various earnings levels, the number of products the company could have could be. If you have earnings of 1, how many products could you have? Could you have 1? Yeah, of course. It could have a profit of 1. That will be it. Could you have 2? Well, if you have one that has a profit of 1 and the other one a profit of 0, that would work. And by the same rationale, really any number of products could work. You just need one that has a profit of 1, and all the others could have break-even profits. So anything goes. Earnings of 0, same story, right? You could have any number of products that are just breaking even, right? So again, anything goes. Earnings of -1. Well, you'd have one product that has a profit of -1, and all the others have a profit of 0. So again, anything is possible. What about -2? Could you have one product that has a profit of -2? Well, we just said, if you're at -2, what do you want to do? You want to discontinue the damn thing, because that's really not worth continuing anymore. You can't really be at -2 except perhaps at the very instant that you hit -2. But otherwise, you really shouldn't see this. So when you see earnings of -2, you really have to have at least 2 products in the world. What about -3? Well, similar story, right? You can't have one product with a profit of -3. And even for 2 products, the worst you could get is that both of them have a profit of -1. So the worst you could get is -2. But -3 would mean that at least one of them has to have a profit less than -1. We said that doesn't work. Companies are optimizing. You got to have at least 3 products here. And so the pattern continues. And so the bigger your losses, the larger the average number of active products must be, on average, right? So if you do that calculation, actually what we had in our little table here is a valid inference. I won't show you the math because you're just digesting your lunch, but trust me, that's how it works. So what does your professor say? Well, I was right. Companies with smaller negative earnings, on average, have fewer products in the world. And the rationale is actually very simple, and we can generalize that a little bit. What does it mean if a company has big losses? Well, it made a choice to sustain these operations, right? Why do we want to sustain operations? Well, we must have enough hope that they'll recover, and that's equivalent to saying the present value of the expected future profits from these operations is still positive and sufficiently large, right? So we really only can rationalize a company having large losses if it also has sufficiently many projects that still have enough value in them, right? This is why yesterday is important. What happened to the companies who did really, really poorly in the past? Are they going to have large negative earnings today? No, because when their operations deteriorated, what did they do? Discontinue them. What happens when you discontinue them? You eliminate the losses from the income statement. Your earnings actually go up, right? So this is important. And there's something I skipped over here. This whole story about Charles Darwin. People in financial economics don't like to talk about Charles Darwin. They like to call this by a different name, which is real options. Real options really means that companies have discretion what to do and when to do it. Right? Cutting products, introducing new ones, what inputs to use, when to act, and so on. Okay? And so once we think about it this way, and we think about that yesterday the company made decisions, we can actually rationalize why you have larger losses but a larger market value. Right? As a disclaimer, since I'm an academic, that's one way to rationalize it. Of course, people might tell you other stories, so take it with a grain of salt, but the main thing is don't be afraid of companies with losses, all right? There are ways to think about them. They're not stupid. It's not a rare coincidence. It makes perfect sense, all right? So that's it from me.